Something happened in the gold market over the last 48 hours that Wall Street saw coming, and almost nobody explained it to regular investors. Hook. Gold is sitting at $4,700 per ounce today, April 12th, 2026. That is an 18% drop from its all-time high of 5,596 reached on January 29th. And if you own gold, if you own silver, if you have any exposure to precious metals right now, you are probably doing one of two things. You are either panicking or you're confused. Because the story you keep hearing, gold is falling, because the dollar is strong and yields are high, is true, but it is dangerously incomplete. There's a second force operating in this market right now, a hidden mechanism that institutional desks were tracking in real time while retail investors were watching price tickers and reading headlines, a force that explains not just why gold fell, but why the drop is going to be followed by the largest single move this bull market has ever produced. I have spent the last 48 hours going through vault flow data, central bank disclosures, IMF filings, and London bullion market reports. And what I found changed my entire framework for what is happening right now. Here is what I found. A sovereign nation, a G20 member with $135 billion in reserves, was effectively margin called by a war it did not start. And it sold 60 tons of gold in 2 weeks to survive it. That one sentence contains everything you need to understand about where gold is right now, where the floor is, and why what comes after that floor is what I'm calling the biggest reset yet in this entire gold bull market. Stay with me, because by the end of this, you are going to see the situation completely differently. And that difference is going to matter enormously to your financial decisions over the next 12 months. Let me start with Turkey, because Turkey is the key that unlocks everything. Turkey's central bank sold and swapped approximately 60 tons of gold, worth more than $8 billion, in just 2 weeks following the start of the Iran war. 60 tons, 2 weeks, $8 billion. Most people hear that number and think, large country, large sale, probably fine. What they do not ask is the question that changes everything. Why? Turkey imports approximately 90% of its oil and 98% of its natural gas. When the Iran war began on February 28th and Brent crude surged from $75 to over $100 per barrel, Turkey's annual energy import bill increased by approximately $20 billion. Not gradually, over a quarter. Not phased in over a fiscal year. Immediately, because energy contracts are priced in dollars. And Turkey needs dollars, not lira, to pay them. The Turkish lira hit a fresh record low against the dollar at least 11 times since February 28th. 11 times in 16 trading days. That is not volatility, that is a currency in free fall. And when a currency is in free fall with inflation already running at 37%, the central bank faces three options. And every single one of them is painful. Option 1, let the lira collapse. Political suicide, not happening. Option 2, burn through dollar reserves. Already doing that, already running low. Option 3, sell gold, convert it to dollars. Use those dollars to defend the currency and prevent the kind of inflationary spiral that brings down governments. Turkey chose option 3, 60 tons in 2 weeks, $8 billion. JP Morgan estimated that precious metals worth approximately $30 billion out of Turkey's total $135 billion held at the Bank of England could be used for further operations if the pressure continues. Now here is what I need you to understand about what that actually is. That is not a strategic portfolio decision. That is not a central bank reassessing its view on gold as a reserve asset. That is a forced liquidation. A margin call, except instead of a retail trader getting a phone call from their broker, it is a sovereign nation being compelled to sell its most valuable reserve asset to defend its currency peg in a war it did not start, driven by an oil shock it did not cause. Turkey did not sell gold because it changed its mind about gold. Turkey sold gold because it had no other choice. That distinction is everything. But Turkey is not alone. And this is the part of the story that I think is genuinely being underreported and genuinely the most important context you can have right now. Russia's central bank began selling gold in 2025 to finance war expenditures, raising approximately $2.4 billion through February 2026 and reducing its holdings to a 4-year low. Russia is selling gold not because it doubts gold, but because it needs cash to fund a war. Poland's central bank, the most aggressive gold buyer in the world over the past 3 years, has proposed monetizing approximately 550 tons of its reserves for defense spending. That is $13 billion. The governor outlined the proposal in early March. Poland has not yet sold, but it has moved from net buyer to seller in waiting. China's People's Bank paused gold purchases in Q4 2025. India's central bank became a net seller in January 2026 as the rupee came under pressure and the Reserve Bank needed liquidity. Now, step back and look at that list as a whole. Turkey selling, Russia selling, Poland considering selling. China paused. India selling. These were the most active, most consistent, most strategically committed buyers of the gold bull market. The institutions whose accumulation drove gold from $1,800 to $5,196. And across a window of weeks, they have shifted, simultaneously, from net buyers to net sellers or sellers in waiting. That is the second force I mentioned at the beginning. That is what the mainstream explanation of strong dollar high yields completely misses. That is why gold is not just pulling back on macro headwinds. It is absorbing a wave of forced sovereign selling that has no precedent in the recent history of this bull market. And now I want to ask you the question I have been sitting with all week. If the central banks that drove gold from $800 to $5,596 are now selling, what actually comes next? The answer, when I look carefully at the data and at 40 years of watching these cycles, is the opposite of what most people instinctively assume. I have watched 4 major resets in the gold market across my career: 1976, 1983, 2008, 2013. 4 distinct moments where the gold price fell sharply, sentiment collapsed, and the narrative shifted to the bull market is over. And every single one of them followed the same pattern. Forced selling hits the market. Not strategic selling, forced selling. Central banks and large institutions that spent years accumulating are suddenly compelled to liquidate because a crisis has destroyed their dollar inflows and they need cash to survive. The gold price falls significantly. Retail investors, seeing the price fall, conclude the bull market is finished. They sell. That selling adds to the pressure. The price falls further. And then the forced selling exhausts itself. Because forced selling is, by its very nature, finite. Countries cannot sell more gold than they own. Crises that trigger the selling eventually stabilize. The dollar demand that the oil shock created normalizes. And when it does, the structural buyers return. The central banks that were forced to sell do not abandon gold as a strategic reserve asset. They sold because they had no choice, not because they changed their minds. And when the crisis passes, when the pressure that forced the selling diminishes, they buy again. Because the strategic logic that drove their accumulation in the first place has not changed. Turkey still knows that gold cannot be frozen with a keystroke. Turkey still knows that a dollar reserve can be sanctioned overnight. As Russia discovered in 2022, when the US and its allies froze $300 billion in Russian currency reserves and sent a message to every central bank in the developing world. Your reserves are only yours until they are not. That realization did not disappear when Turkey was forced to sell 60 tons to defend its lira. Turkey sold gold because it needed dollars in a crisis. When the crisis passes, Turkey will buy gold again. Because the thing that makes gold irreplaceable, no counterparty risk, cannot be printed, cannot be sanctioned, cannot be devalued, that did not change. This is what a reset is, not the end of the bull market, the clearing of excess, the forced liquidation that creates the conditions for the next, larger move. And I want to be precise about why I'm calling what is coming the biggest reset yet. In 1973, when gold began its historic move, the United States national debt was approximately $500 billion. Today, it is $39 trillion. That is not a larger version of the same thing. That is a categorically different fiscal reality. One that creates a categorically different, structurally larger long-term demand for gold as a hedge against monetary debasement. In 1973, no central bank was buying gold strategically at scale. Today, central banks are forecast to purchase roughly 850 tons of gold in 2026, almost identical to last year, and still historically elevated far above the pre-2022 average of 400 to 500 tons annually. The institutional infrastructure for sovereign gold accumulation is now global, sophisticated, and deeply entrenched. In 1973, there was no silver supply deficit. There was no AI infrastructure driving industrial metals demand at scale. There was no de-dollarization movement of the magnitude we are witnessing today. And here is the structural fact I keep returning to. When the US and its allies froze Russia's currency reserves in 2022, every finance minister and central bank governor in the developing world took note. If your reserves can be frozen with a keystroke, they are not really yours. Gold cannot be frozen. Gold cannot be sanctioned. Gold cannot be printed into existence or devalued by a political decision made in Washington. That realization is now embedded in sovereign reserve strategy in a way it simply was not in any previous cycle. The forced selling that is happening right now does not erase that realization. It temporarily overrides it because crises create urgent dollar needs that override long-term strategy. But the long-term strategy returns when the urgent crisis passes. Every structural condition underpinning this gold bull market is more extreme than in any previous cycle. More debt, more central bank buying as a baseline, deeper silver deficits, greater industrial demand, a more fiscally constrained Federal Reserve, and a geopolitical fragmentation that is pushing sovereign reserve managers toward hard assets faster than anything we have seen in 50 years. This is not the end of the bull market. This is the biggest, most dramatic, most consequential reset within it. Let me give you something concrete. Because a macro framework without a practical structure is just analysis. Here's the three-phase playbook for what I believe happens from here. Phase 1, the forced liquidation phase. This is where we are right now. Gold at $4,700, down 18% from its January high. The sellers are not making strategic decisions. They are meeting obligations. Turkey is defending its lira. Russia is funding a war. Poland is weighing defense spending. The selling pressure is real, it is large, and it is, by definition, finite. How much forced selling remains? Turkey's central bank reported a combined drawdown of 58.4 tons across two recent weekly reporting periods, 6 tons in the week of March 13th and 52.4 tons in the week of March 20th. JP Morgan estimated approximately $30 billion in precious metals could be used for further Turkish operations. That is a number with a ceiling. Turkey does not have infinite gold. The Gulf state selling that has been rumored in the market. The IMF data does not confirm it. Saudi Arabia's official holdings appear unchanged. The UAE and Kuwait show no confirmed sales. The rumored selling from Gulf states may be adding downward pressure through sentiment rather than actual supply, which means when that sentiment reverses, the supply pressure it created reverses with it. There is also Russia's April 2026 deadline. Russia is banning gold exports above 100 grams effective April 2026. Every Russian gold holder who wants to move assets into the international market has days remaining to do so. That pre-deadline liquidation is adding near-term selling pressure. But when it exhausts itself, when the Russian export window closes, a significant source of current selling pressure is removed permanently. And a major gold-producing nation is simultaneously locked out of the international export market, tightening future supply at precisely the moment structural buyers begin to return. Phase 2, the stabilization phase. This begins when oil stabilizes, when Saudi pipeline capacity and alternative supply routes through Emirati bypass infrastructure absorb enough of the Hormuz disruption that the emergency dollar demand from energy importing nations begins to moderate. Trump has indicated negotiations with Iran were underway as of March 26th, though Iran denied it. Whether or not those talks materialize, the oil market will find a new equilibrium. When Brent crude settles into a range of $85 to $95, the marginal dollar pressure forcing Turkey's hand diminishes. The lira stabilizes, the forced selling slows, and the gold market begins recalibrating toward its structural price rather than its crisis liquidation price. Phase 3, the structural re-entry. This is when the central banks that sold during the crisis begin to rebuild. Not immediately, but within the 12 to 18-month window that historical resets have typically taken to complete. China has not abandoned its accumulation program. The PBOC extended gold purchases for 15 consecutive months through January 2026. India's selling was currency pressure driven, not policy driven. The strategic buyers have not left. They have paused or been forced to sell temporarily. When they return to a market where the forced selling has already occurred, where the price has already reset lower, where the accumulation opportunity is larger than it was at the previous highs. That is what a reset is. That is what resets have always been. I want to be specific about the two indicators I am personally watching to identify when Phase 2 has arrived. Not gold price targets, not analyst forecasts, the upstream signals that will tell you, before the price moves, that the conditions driving the forced selling are beginning to moderate. Signal 1, the Turkish lira. The lira has hit a fresh record low at least 11 times since February 28th. 11 times. When the lira stabilizes, when it stops making new lows against the dollar, the pressure on the Turkish central bank to liquidate gold diminishes. One of the two largest confirmed sources of forced selling in this market will have turned. Watch the USD TRY exchange rate. When it stops making new records, watch gold closely. Signal 2, Brent crude. Every week, oil stays above $100 is another week of elevated dollar demand from energy importing nations. Another week that forces Turkey's hand, drains Gulf state dollar reserves, and pushes central banks toward liquidation. When Brent crude falls toward $85 to $90, the fundamental driver of this entire forced selling sequence begins to moderate. Watch tanker traffic data through the Strait of Hormuz. Watch the spread between Brent and WTI. When the supply disruption premium begins to compress, the selling pressure in gold begins to ease. The dollar, the yield, the lira, the crude price, these are the signals. The daily war headlines, the financial media's anxiety cycle, the gold price ticker. Those are the noise. Know the difference. JP Morgan has raised its gold price target to $6,300 per ounce by end of 2026, with an $8,000 upside scenario on the table. Those targets were set before Turkey's $8 billion sell-down. They have not been withdrawn. The institutional research departments that issued them are not watching gold fall from $5,596 to $4,500 and concluding the structural case has changed. They are watching forced liquidation create the buying opportunity that precedes the biggest reset yet. I have watched 4 of these cycles play out over 40 years. I know what they look like from inside them. They feel like the end. The price is falling. The news is relentless. The narrative is shifting. The investors who bought at the highs are questioning everything. And the investors who understand the mechanism, who understand the difference between forced selling and strategic selling, between temporary liquidation and permanent reversal, are making the decisions that will define their financial outcomes for the next decade. The floor for gold, based on everything I am reading in the data right now, is somewhere between $4,000 and $4,500. That is not a promise. That is a structural assessment based on where the forced selling is coming from, how much gold those sellers have left to sell, and what happens to the upstream pressures when oil stabilizes. The reset creates the floor. The floor is the launching pad. And the launch, when it comes, backed by more debt than any previous cycle, more central bank buying, deeper silver deficits, greater industrial demand, and a Federal Reserve that is more fiscally constrained than at any point in the modern era, will be larger than any move this bull market has produced so far. Turkey sold because it had no choice. Russia sold because it had no choice. Poland is considering selling because it may have no choice. None of them changed their minds about gold. When the choice returns to them, watch what they do, watch the lira, watch crude, be patient, and do not let the most significant forced liquidation in this bull market's history cause you to miss the biggest reset yet. The floor is forming. The structural buyers are waiting. And the institutions that have already done the math are not selling. They are watching, and they are ready.